Hi, this is Anna Bolet with Momentum Realty, and you're watching Anna Banana in the 904. So today I'm with my preferred lender, Seymoine Schmidt, super lenders with FBC Mortgage. And we've got a lot to talk about because there's been lots of changes this year. So it's 2022, we're in full swing. Some changes have occurred with the conventional loans and how that's going to affect our self-employed buyers. Can you talk to us about that?
Sure, absolutely. So the changes that we saw when COVID first came out was additional documentation requirements from Fannie Mae. Some of those requirements amounted to devastating amounts of paperwork from the customers, additional verification that businesses were up and running, which included more paperwork and more documentation. And typically we had to verify your business was up and running 10 days prior to closing with your CPA. Therefore, here's the other challenge. CPAs don't normally like to give out information. So you can imagine it was pretty horrendous. So the great news is, as of February 3rd, 2022, Fannie Mae has lifted that COVID requirement. So we no longer have to do all of that extra paperwork. So much easier for the customer.
That's awesome. So tell us about the rate changes, because rates are kind of creeping up now.
Yeah, we've seen a little bit of creep up in interest rates. Economy's still trying to gain momentum. We were in the high twos probably back in November. Right now we're at about 3.75 average for a 30-year fixed rate mortgage. And it's not that bad though. It's still affordable.
It's still historically low rates though, right?
Correct.
Yeah.
Yes, absolutely.
So what do you think is going to happen with the interest rates this year? Now, I know you don't have a crystal ball. Mine broke a long time ago. They told me it can't get fixed. My concern is, though, that if rates creep up, we're going to find a huge flood in the marketplace for buyers trying to lock in these still historically low rates. And then my other concern is how high do they have to go before there's no more demand, or explain how that affects our demand.
Okay, so I'm going to answer it in a couple different parts.
Yes.
So, with rates going up, it's still not that big of a difference in payment. Let's use a $500,000 loan, for example.
Okay.
Let's say someone's buying a property, they're putting like 20% down, and they are financing $500,000. At 3.75, which is current market, the principal and interest payment would be $25.47 per month. That's not too bad. That's still very affordable for most people. Now, if the rate was to jump to, let's say, 4.75, which I don't see it doing that in the very close future, maybe in the distant future, because again, we still have some struggles with the economy. We still have some unemployment, stuff that's hanging out there. So there's many reasons the rates are pretty steady. But it did go to 4.75. Just to kind of reiterate and go back to your question, $500,000 loan finance, that's 20% down, 4.75 rate. That would be $28.69 per month.
Wow.
It is a big difference. It's $322 a month. That's a big difference, and in some cases that can make or break, a client qualifying for that price.
So it's still something, though, when you're talking about like renting versus purchasing a home, because there's a lot of people. I've got renters right now who are contacting me and they're getting ready to jump into the market. They're a little bit worried. And a lot of times they're thinking, well, I think I'm just gonna stick it out another year and see what happens. Like, what would you say to that?
Okay, honestly, here's my opinion. Everybody seems to hear this, right, talking about, oh, houses are so overpriced. Honestly, they're not. If you look at it with what the current rate is right now, around 3.75, and that's your standard conventional vanilla rate. You're not buying at a premium today. you're buying at a discount tomorrow because of the difference in rate, the difference in payment. That rate, 3.75 versus 4.75, $388 a month in difference for the same loan amount. That's your discount, is getting it today at the lower rate.
So my advice is always, if you can and you can qualify for a loan, is to purchase real estate, because real estate historically is still a very strong investment. And to point out, and I talked about this in my last couple of videos, that here in Northeast Florida, our market increased by 14% over 1 year alone. And that's still higher than most stock portfolios. When you put that into perspective, stock portfolios are going to increase an average of 10%. That's kind of what you want, right?
Sure.
So we're also seeing a big flood of investors coming in and buying up properties as well.
So your question, why should people buy instead of pay rent? I mean, that's pretty easy answer. You know, you don't have any ownership in the property that you rent. It's somebody else's property. You know, you cannot lay down your roots there. You can't make a homestead. You can't raise your family there forever. Who wants to pay rent? It's money you're throwing away. You can still get an affordable mortgage in a lot of cases that's going to be equivalent to rent or possibly less, because rents are going up everywhere. I mean, the rental market is on fire. A lot of people don't qualify to rent. So it's worth it to talk to someone like me and weigh the options for renting. Investors, you had mentioned investors too. Investors like coming into the market and buying up homes. We are seeing that a whole lot. Those are going to be your cash investors. Those are going to be people that borrow against their margins most of the time, the stock margins, and that's how they're able to pay cash. They're doing margin loans. So that's why you don't see investors financing. Yeah. So, but you're going to have that in any market. I don't think it's going to be the same as it was in 2008, where the investors came in, they bought everything up, and then the market tanked and crashed. We're not going to see that. Florida right now is the new California. You know, we're just catching up to the rest of the world. We've been lucky here on the East Coast, North Florida area, that our home prices have not skyrocketed a lot sooner. So I think we're just at the new norm with the market.
So wasn't it that like in 2008, and I wasn't anywhere, I did not know anything about real estate. I didn't understand finance, none of that stuff. But wasn't it like part of the reason why we had the debacle was because they were giving, like, everybody was an investor because they were giving everybody like loans, like you could just kind of qualified.
Absolutely.
So people were just like, oh, I'm just gonna buy this house and then invest.
And flip it, or So there's a lot more scrutiny with qualifying since that whole debacle. You know, Fannie Mae certainly put in some good requirements for lending, and it's kind of gone back to the old traditional way of lending, where we actually verify your income. We make sure you have the money for closing. You know, you've had a job for a couple of years, your credit's good. So all of those old-fashioned requirements that we had in the beginning of lending are coming back, but that's also going to be our safety net for foreclosures. Because people do qualify. You have to qualify to get a house.
Right. And we were, I think we were talking about this, like it's the amount of equity that people have in the state of Florida is quite a bit. And
absolutely.
Yes, we're going to start seeing foreclosures. That only makes sense because they're starting to process them now, but I don't think we're going to see as much as people were expecting because people have equity in their homes.
Right. Absolutely. So the people that have the equity in their homes, they are cashing out. So they do have that potential, you know, savings. So if there is something, you know, that comes up with their, you know, losing their job, they're going to have money to dip into to keep that mortgage payment going. I had a customer that bought a house 9 months ago, and this is just one example. The house has increased in value $150,000 in 9 months.
So let's talk about that a little bit. It's very challenging to get under contract.
Right.
Very challenging to get under contract, and I have a lot of buyers who look great on paper. You know, they're ready to go. but they still need to finance. And they know they're going up against the cash buyer. Sometimes the cash buyer well, for the most part, the cash buyer is going to offer either at or below the asking price.
Sure.
And so talk about that. Like, is there a way to make that that financing offer better?
More attractive?
More attractive, yes.
Yeah. I think the way to make a financing offer more attractive to a listing agent or seller is to definitely 100% be pre-approved, not just this person looks good on paper because they say that they're good. I mean, really have your lender do the due diligence, and due diligence is reviewing the pay stubs and the W-2s, verifying they really, are working. Because a lot of times what has happened is people will, self-employed borrowers will use those. They'll think, oh, I make, $20,000 a month in my business. Well, on paper, you do not, because of the way your accountant, does your tax returns, which is great. That saves you money. I mean, that's awesome. But when it comes to qualifying for a home, you have got to show income. So when you have a finance buyer versus a cash buyer, one thing that would help them to get that contract is, one, offer above sales price. Have the escalatory clause in your contract, so it can go up, $10,000 at a time, $20,000, whatever it takes. And bottom line, the sellers want to sell their house for the most money they can. I don't think it matters if it's really cash or if it's finance. They're going to go for the best price they can get for that home.
So where do you go into play? Because I know that whenever a lender calls me on the selling side to give me a good report, good review on their buyer, like that really does have weight. So talk to me about that.
Absolutely. I think it's very important to communicate with both sides. So I always contact both.
That phone call is just on the behalf of the buyer, and I feel like that 9 times out of 10, whenever the lender has called on behalf of my buyer, or I've received that phone call, it just carries that much more weight. That extra step really goes a long way. And I have seen where those kind of contracts will beat out the cash in some instances. Yeah. And I think we talked about this before, that there's a lot of cash buyers, especially the investors. They're trying to beat the system in the sense that, because there's such a frenzy right now, they will put a bid on any and every single house that they think that they can afford. It's a lower, sometimes it's at or lower than asking price, and they're still are requiring, because you can, in the state of Florida, you have either 10 days or with our contract up to 14 days for the inspection period. So they'll hold on to it for 14 days, do the inspection, tie it up.
Right, because they found something in the home inspection report.
Yes, or
that they feel like they justifies, paying less for the property. Yeah, I mean, unfortunately, I don't know there's a way around that when it's an investor. I think doing the due diligence, up front, and when it is financing, we know that the buyer is solid. Whereas an investor, like you said, they're putting out multiple offers to tons of properties. Who's to say they're not going to walk away from 9 out of 10? Right.
And so I think that's also something that we have in the favor of the buyer. You can talk to that, of course, coaching the buyer as far as, let's make sure that we have some sort of cushion in case something comes up with the inspection. Let's talk about the appraisal contingency and how we definitely have to put that into our contracts these days. But also, I'm going to lead you here too. It's a two-parter. So the appraisal contingency, what does that look like for a buyer that puts down 20%, right? Versus the 5%, and how do we manage all that? It could be risky, but there's something, there's like kind of like a slide with you put more money down, you can use that you can kind of slide that around, but that's not my lane. Go ahead and talk about that.
Okay. So, appraisal contingency. So every contract is going to have an appraisal contingency. What we're seeing more and more on the financing side is extra language in the contract that'll say the buyer, if the property doesn't appraise, buyer still agrees at, you know, the same sales price, but they'll bring the cash difference to closing. And that works. That works a lot. That works really well. If a buyer only has, let's say, 20% to work with total, and they're using that 20% down because they don't want to pay PMI, and the property doesn't appraise. So there's definitely a way around that where you don't have to pay PMI. And that's what people don't know.
Oh.
You still don't have to pay PMI if you have less than 20% down. So if you have that contract that's got the contingency where they're going to pay the difference between the appraised value and the low appraised value and the sales price, they still have only got the 20% to work with. As long as they can retain 5% of that 20%, and do 15% for the shortfall of the appraisal, they can still get into that house with no PMI. So there is a program, and I use it a lot for my buyers. It is called lender paid mortgage insurance. There's also borrower paid mortgage insurance. So with the borrower paid, it's super simple. For example, let's say 5% down. Obviously, you'd need 15% down, you know, traditionally to avoid PMI. So with borrower paid MI, you can pay a premium up front to have the mortgage insurance waived. You have to think of it like an extra closing cost. That premium is based on your credit score, 90% of it. Okay, so it's based on credit score, debt to income ratio, of course, and loan to value or down payment. Again, 5% though. You pay this extra premium. It's just like another closing cost. You pay it at closing. You do not have PMI monthly ever. It's an amazing product. Amazing. Typically, the interest rate is about the same. Sometimes it's a little uptick on the rate if they're doing borrower paid. It all depends on the credit score.
Right.
But at the end of the day, if you look at it and compare it with the customer, they're going to save money because there's no PMI. And it's always a lot cheaper than putting the additional 15% down. The premium's usually a couple of $1,000s. So a couple of $1,000 versus 15% down, huge difference. So I'm your out of the box lender.
Yes, I love it. Yes, you are. Okay, so this is Buddy.
Hi. This is Buddy Schmidt, Super Lender Buddy Schmidt. He's our mascot.
So let's talk about that first time buyer. And a lot of times they're not going to put down 20% in a contract for a loan.
Correct.
And what hurts them, or what is perceived as hurtful, is that sellers always equate like a higher down payment to a better,
more stability. Yes.
So talk to us about that.
It's not necessarily true. And here's the reason why. If you can borrow money on a mortgage at an interest rate of 3.75, we're just going to use that as an example, and your payment's not going to be much higher than your rent, and you can do that prepaid MI thing as well. Why spend all of your money, your down payment money, on a house?
Right.
Keep it in the bank, have some cash reserves, buy furniture, you know, do upgrades, buy a car. I mean, there's all kinds of things you can do. Don't buy a car, by the way. Don't buy a car till you close on your mortgage, please.
Yes, please, no.
Yeah, no, it's a big no-no. But so, you know, I don't know how to answer like the part where, you know, what would make it attractive to a seller, 5% down versus 20% down. I think if the 5% down customer that does have the money in the bank and can afford to go over list price, and they do go over list price, I think that's going to be stronger to a seller, because at the end of the day, the seller cares about one thing: getting the most money for that house that they can.
Right.
Right. Yeah.
And I think also it's having that conversation too. Like if in the best case scenario where you have been able to talk to all parties, where there's open communication and transparency in that case, and you're able to say, hey, this buyer has the money to be able to do so. This will finance.
Right. Here's my advice: is to leave all your money in the bank, because the fatter your bank account is, the better. Yeah. It really is.
Well, thank you, Simone. That was really good information.
Thanks, Anna.
I think that this is going to be one heck of a year. Like last year, I don't think things are going to slow down anytime soon. But lots of good information for buyers and sellers out there. So make sure you stay in touch. This is Anna Bolet with Momentum Realty, Anna Banana in the 904, and Simone Schmidt with Buddy.
Keep me in mind, please, super lenders, for your financing needs for you and your family, whether it be your kids or your four-legged kids.
Bye, everyone.
All right, bye. Thank you.